Thanks again for joining us for another episode of Lessons into Blessings podcast, where we are leveling up investors in their financial freedom by sharing stories and strategies of everyday people who've changed their financial trajectory through real estate. Today, we have with us Randy Smith, who is joining us from our home state, Phoenix, Arizona. And he's a passive real estate investor focused on multifamily, mobile home, storage, and ATM asset classes. He's the co-host of the Gentle Art of Crushing It podcast, which I absolutely love that name. And you could share kind of what that gentle art is. I love it. And the founder of Impact Equity, which is he does fund to fund. He's a fund to fund manager, finding great deals for passive investors to invest in this local Phoenix, Arizona market. Randy has over 25 years of experience in B2B sales, working for large Fortune 500 companies, and has now transitioned full-time into real estate. So if you guys can help me welcome Randy Smith.
All right. Tari, thank you so much for having me on the show. It is an honor to be here. Thank you.
No worries. I love your background and kind of where you've started. And I think your story will help folks just know that it's a journey, right? Because you were in the working world for quite a bit of time. And so congratulations on making that transition. That's huge.
Yeah, thank you. Thank you.
Yeah.
It was not planned, but I think it'll be a blessing in disguise. So
Yeah. And I would I think it'd be great to maybe start off with that and just, how you made the transition, and, you can talk about the unplannedness and how you still made it work.
yeah, no, absolutely. I'll give you kind of the Reader's Digest version of my path to entrepreneurship, I guess. So yeah, as you mentioned, I worked in corporate America, primarily in sales and sales management for about 25 years. I had the honor of working for a couple of really, really fantastic organizations for 10 years apiece. And about halfway through my tenure in my most recent employment, I got to a position financially after kind of following Dave Ramsey's guidance and going through the baby steps, where we started to actually accumulate some additional capital in addition to the bills and the mortgage payments and all of those other things.
Definitely.
And we knew that once we got comfortable with our finances, we were going to start looking at real estate.
Mm-hmm.
So about 5 years ago, we started investing. At the time, I thought it was passively by buying some turnkey properties out of state. And I will say that it was anything but passive. And it was not a very positive experience. We had a lot of hiccups with that path. And then we shifted over to doing the BRRRR strategy out of state as
And the
well.
BRRRR, buy, rinse, repeat. No,
Yeah,
buy,
buy, rehab,
rehab.
rent, refinance, repeat.
Correct. Yeah,
Um, so buy the ugly house on the street, fix it up, put a tenant in it, and
exactly.
refinance, right?
Yep.
So we did that a handful of times, and then found pretty quickly that that was going to be really difficult to scale. So we ended up looking into multifamily, as so many people do, and thought that I would passive invest in multifamily just to kind of peek behind the curtains
Yeah.
and see if that was something I wanted to do full time. And just fell in love with the passive investing space and have been doing that ever since.
That's very cool. So what about the passive investing side that really attracted you?
Yeah, so I think by definition, passive investing should be vetting an opportunity, placing your capital, and then waiting for the checks to come in or the
Right.
ACH deposits to come in.
Yeah.
And when I first got into what I now call my active real estate investing phase, which was turnkey and BRRRR, I thought that was going to be passive.
Right. And a
Um,
lot of people make that mistake, right?
yeah, and it
Mm-hmm.
ended up taking a ton of time. And I was having weekly calls with property manager, weekly calls with construction managers, weekly calls for whatever random issue that was happened to come up. And it actually pulled me away from my W-2 quite a bit for a few years. fortunately, I had some autonomy in that role, so I had the flexibility to do that.
Right.
But it was not passive by any means. I was very actively involved in those deals.
Yeah. And so, if you were to explain kind of the fund to fund, because that's what you do now, you're helping, you're working with syndicators, you're working with people who take down, these large deals, and you're helping them to find opportunities, right?
Yeah.
And so getting into that space and being kind of like, hey, for you to say, you know what, I'm not going to find another job. I'm going to kind of stay in this passive investing space, and maybe help other people find great passive investing. What made that transition, and how do you really ensure that the people who are investing with you are investing in the right type of deals?
Yeah, really, really good questions. And it was really kind of a neat story how the whole thing evolved let's see here. I had started passively investing a couple of years ago. And, I had my journey where I had to make that first passive investment. I had to wire the dollars to some company that I had never technically met in person. It was a brand new space that I really knew hardly anything at all about. But I took those actions and did everything that I knew how to do at that time to make sure that I placed the capital in good investments. And over the course of a handful of years, I ended up investing in about 18 different deals with 8 different, the term operators. So 8 different businesses.
Yeah.
And I've invested in 4 different asset classes. So I've learned these skills of how to vet operators and asset classes and take a look at a specific deal and see if it's a good opportunity.
Mm-hmm.
And I was having a really good experience with it over those years. And once you start getting that first disbursement check that comes, it's like a holiday and you're all excited and you're high-fiving your wife like, hey, they're actually sending us money and I don't have to do any work. This is amazing, right?
Right.
And as you get more and more of those, like disbursement or the day that those start hitting the account gets more and more exciting, because it actually starts to really accumulate into some real dollars, right?
That's very cool.
So yeah, as I do that, you'll tell, if you don't know already, I am one of those guys that when I'm excited about something, I tell everybody about it. Like I am a shout it from the mountaintop guy. And because of that, the people around me were excited about what I was doing. And then they started investing passively as well.
Yeah.
So I had referred a ton of business or a ton of investors to one of my local operators. So when I ended up getting laid off, I had just a brief conversation with him and he's like, Randy, you've already been connecting investors with good deals, but you haven't actually been involved in those deals other than investing in them.
Right.
Why don't you do that professionally? And like the light came on, the aha moment. And really the path was very clearly identified and it was able to step into that role and kind of hit the ground running. And it's been a lot of fun so far.
No, I love that. I love that you found that strength. You found your superpower kind of somewhat, right?
Yeah, absolutely.
So share with us kind of a little bit about your vetting, and I'm gonna break it down in kind of some of the areas that you talked about. So, what is it that you look for? Because you've been in a lot of diverse asset classes.
Yeah.
So what are some of the things that you look for in asset class? What are some of the types of things as you're investigating that as a LP?
Yeah.
What does that look like? What does that process look like?
Yeah, very good. So the very first thing that an investor needs to ask themselves is, what type of investor are they? And what do they want to get out of this? Are they looking to just park some money on the side and not lose any spending power with it due to inflation? Or do they really want that bucket to grow as fast as possible and they're not concerned about monthly distributions? Or are they trying to leave their W-2, and will they need income from these assets starting at some specific time? And to be transparent, I did not know that when I started investing passively. I just was really excited about this idea of giving somebody my money, give them to the expert, because I found out pretty clearly I am not the expert at BRRRR strategy or turnkey strategy. So find an expert, find a good jockey, and give him my money, and then give it to me back. Like that
Right.
in and of itself was better than what I was doing before.
Yeah.
So as I had a few more investments, and as I was at the time, I was a high W-2 income earner. So I didn't necessarily need big monthly distributions to live
Yeah.
on.
Mm-hmm.
In fact, in hindsight, I didn't even really want them because I didn't want to deal with the tax consequences of having more income then,
Gotcha.
right?
Mm-hmm.
The goal really was, I want this bucket to get as big as it possibly can so I can leave my W-2 and then live off that, right?
Yeah.
So first and foremost, are you a cash flow investor, or are you a growth investor,
Mm-hmm.
or are you just simply a capital preservation investor?
Right.
So once you know that, you can go out and find the right investments. And, the asset class, I would say, is probably less important than a lot of the other metrics in the due diligence process, because you can make money in almost any asset class at any time. Some do better.
What would you say the spaces or the asset classes, if they were capital preservation, or if they were cash flow, or if they were growth, does one asset class type, help, and that's, in one space or another? So if I was cash flow, does, ATM kind of make a better, you get what I'm saying, right?
I do absolutely. Yeah. So yes, in the extreme, there are some asset classes that are going to kick off amazing cash flow, monthly cash flow, but there might not be a big upside on the back end. And ATM is definitely one of those. Mm-hmm. Now, ATM funds, and this isn't a term that I've learned in the industry. It's something that I've kind of coined myself, but it's a declining value asset. So you make X amount of dollars per month for X amount of years, and then it's gone. Like you don't get a big check at the end. It just simply is gone. Yeah. They might sell the ATMs for scrap essentially after 7 years. Because think about it, an ATM machine is simply plywood with some plastic or metal around it and a computer chip, and that's it, right? Whereas real estate, like actual real estate, is appreciating in value just by, yes, you can drive additional value, but it increases in value just because real estate increases over any amount of period of time. It will increase over time, right? So when you start looking at growth versus cash flow, I think it's more important on what type of business plan or business model is being leveraged in the strategy. So the good example there, probably the best example, is any type of development opportunity is not going to be a cash flow play. Right. You're not going to get cash flow while they're building an apartment, a self-storage, a mobile home park. You don't get cash flow, so you cannot live on that. Whereas like C-class value add apartments, you're going to get much more. Well, actually, that's more of a growth play as well. But
it can be a little bit of both, right? Cash flow and growth, depending on the market.
C-class in the Midwest versus the Sun Belt, you're going to get more cash flow out of the Midwest than you will out of a Sun Belt asset. Correct. Essentially. Yeah. Okay. So a lot of different variables to consider, but I think you can be a growth play or a cash flow play in most of the asset classes, depending on the business strategy that they're using.
Yeah, no, that's good. So we talked about asset classes there. Now talk about the operator, because I think that's one of your big areas of just vetting who's doing the deal, right?
Yeah. And I mean, at the end of the day, these are businesses. So you're betting on the fact of whether this business owner, business operator can execute their business plan or they can't. Mm-hmm. And the biggest indication of future success is past success, in my opinion. Yeah. And certainly past success does not guarantee future success. But if somebody has built a cookie cutter house 10,000 times in the past, the odds are that they're going to be able to do it 10,001 times is much better than the guy who's starting out with number one, right? So I always want to put my money with somebody who is highly skilled, has high experience, and has done this business plan a number of times.
Yeah.
First and foremost. Now, one of the things I've been talking a lot about lately is at times you might have to pay a premium to place your capital with somebody who is the absolute best at what they do, meaning you might not get the absolute best returns that you can. But is it better to have safe returns over big, huge returns with higher risk? That really just comes down to your risk profile.
Yeah. And I think that's risk threshold. And I was talking with someone else in that space as well of, there's a trade-off to that. Like, obviously no experience, that might be a little bit more shaky, but you may have people who are more hungry to go after a deal and hungry to really get their investors bigger returns versus, an operator that's been there forever, but it's, you're going to get a stable return. So I definitely.
Yeah. And I think it's really important too, like for like folks like you and I, we've been in the space for a shorter amount of time, but you and I have track records. Like you worked for one of the most well-respected brands in the world for many, many, many years.
Yeah.
And you don't get careers and have careers with employers like that if you're not an absolute stud. Right?
Yeah.
So your track record, albeit in this industry, is a little bit smaller than maybe some of these other folks. Your track record going back to your prior employment and your education is like bar none to many of the folks in the space.
Yeah.
Right.
Yeah.
So
no, good call out, and appreciate that. But it's definitely seeing what they've done previously and how they've been able to succeed at those things. Right.
Exactly.
Because people will eventually make it transfer to other spaces too, as well.
Absolutely. Yeah. And like I said, at the end of the day, this is just a business like any business. So if you're a good business operator in any setting, there's a lot of transferable skills that go with you.
Yeah. Absolutely. As far as what to look for as an LP in returns, if you are cash flow versus growth, and we'll just focus on those two because those are probably the most prominent.
Yep.
Return wise, what are you looking for if you're and I know you're what would you consider yourself? Let's ask that first.
Well, I very much was a growth investor when I was in my W-2, but I am very much a cash flow investor today. So
you can speak to both sides.
Yeah. So especially like 2 weeks from today, I will have my last severance check. So yes, I am a cash flow investor through and through now. So
got you. No, understood.
Yeah. So what are good returns in those spaces? That's a really good question, and that changes as the market changes as well. So
for sure, yeah.
I will tell you that there are a lot of operators out there that will offer debt options to investors at 8 or 10%, which is not guaranteed returns, but it is preferred returns.
Right.
And they're the first folks paid, right? So if you're sitting on a big bucket and you want to place that capital in deals, it's pretty safe to say you can find plenty of deals that are going to pay you 8 to 10% annually, which compare that to the old 4% rule, which I was brought up being educated on. That's more than twice as much as what the standard traditional investment advisor would suggest that you could live on. Okay.
Right.
So I think if you're in the 8 to 10% range on the cash flow, that's fantastic.
Yeah.
If you're in the growth phase, the traditional deck that you will see, the traditional pro forma that you're going to see is, 4 to 5% distributions, maybe 6%. And on the back end, you're going to see IRRs in the 16 to 20% range.
Right.
So about double of what you see in the cash flow play.
Right. Right. And that's over a certain time period, like 5 years, 3 to 5 years. And now probably I'm seeing stuff longer, right? With longer holds possibly.
Yeah. Yeah, absolutely. Absolutely. And, my first passive investment that went full cycle in 14 months. So I got a 1.8 equity multiple in 14 months.
That's a
And in the
beautiful
same time period, my stock holdings dropped by 30%. Right. So, yeah. So just part kind of illustrates the value and the power
Yeah, no,
of this
that's a
private
really good
placement place.
just valuating and validating a good deal. And you've spoken to this a little bit as a new investor coming in. How do they, get started just validating the operator, validating, the
Yep.
pieces that are important to knowing, hey, am I investing in a really good deal?
Yeah. Yeah. So if you hang around the space long enough and you start to network with folks, the absolute best way to place your first capital is to get a good, solid referral from somebody who has been investing with them historically.
Yeah.
Okay. It's just like anything. The
Yeah.
very best experience is going to come from a personal referral.
Yeah.
If you don't have a personal referral, what I did is I educated myself by podcast, university, and all kinds of books for years, probably too many years before I took the plunge. But I ended up placing my dollars at first with a couple of very large syndicators or operators in the space because I'm a big brand guy. I've worked for two very large, well-respected brands.
Yeah.
So I wanted to place my money with large, well-respected brands because brands are powerful, right?
Yep,
And
yeah.
the odds of, one of the largest syndication companies in the country or in the world for that matter, going belly up and not paying me good returns is much higher than me going with, Johnny next door syndicator that I don't know about and nobody else does. So
yeah,
I place my money with big brands until I gain the skill and the expertise to actually do the due diligence that I need to do. Right?
Yeah, no, that's good.
Yeah. Another option is to partner with an operator that does know those things and put your trust in them, which I've done that as well. And now I'm hoping to become one of those trusted partners myself.
And how did you create those relationships with those trusted syndicators? How did they even give you your time, right? Like some people are big, right? They're big and they're trusted. So me, new person, Tom Smith, trying to get, their attention.
Sure.
How do you really associate yourself? How do you kind of, create a space to say, hey, I'd like to be taken seriously. I'd like to kind of learn from you, etc.
Yeah. And a really good question as well, because there's a lot of syndicators that don't want a new investor who's going to be blowing them up on text and phone
For sure.
and send them 100 emails. So they're that know, like, and trust piece to the investment journey is important. And if you're a new investor and you want that white glove, you want the hand holding, I would just suggest getting on the phone with as many operators as you can until you find somebody that you really connect with. You and I might not connect with the same people, right? I might have different needs and wants and desires out of that community. Just as many types of personalities there are that many types of syndicators as well.
For sure.
So I say just find somebody you get comfortable with that is going to give you the level of attention that you require and you deserve as an investor. And if you're not feeling the love from somebody, thank them and have a nice day and move on to the next one. Exactly. Next, there are, but I think what we'll find, and I've seen a couple of cycles in the economy here, is that I think the best operators will make it through this with flying colors.
Yeah.
And, in my experience, the people that make it through the hard times are the people you want to put your money with in the first place.
Absolutely. And I think this period is definitely going to test that for sure.
Absolutely.
Right.
Absolutely.
We've seen really a lot of gravy and over the past 3-4 years, and you could cover up a lot of mistakes. So now that the tides have come down, you're going to see a lot more rocks, right? And
absolutely.
So
I'm sure glad that I am not buying turnkey properties or BRRRR properties right now,
understood.
because a lot of my mistakes were righted from the rising tides that we all got to take advantage of. So
yeah, and so great transition actually, because that's usually how we end our podcast, is just talking about kind of some of the lessons that we've learned over our real estate journey, because we're believers of, lessons can turn into blessings if you're really looking for the opportunity for it, right? So
absolutely.
I never waste a lesson, and I've had some painful ones, right?
Absolutely. Me too.
So,
Me too.
what would you think is the biggest lesson you've learned from maybe some of your mistakes along the journey, and what can our listeners take away from those lessons?
Okay. When I look back at probably the biggest mistakes I've made in real estate, is when I have been given advice by an expert and not taken that advice. So I had a situation where I bought a property in Atlanta. I got an inspector to come in and take a look at it. And he said, hey, you should really get a foundation expert out here to take a look at this thing. And when I talked to my realtor about it, my realtor, whose incentive was selling the deal,
For sure.
Said, I've got a guy that can come out there and take a look at it. And sure enough, the guy thought it was a great, the guy came out, took a look at it, said it wasn't a big deal. And then when we got into construction, it ended up being a teardown.
Wow.
And, had we continued to throw money at that thing, we would have probably been out of pocket. I mean, we could have been out of pocket $100,000 on that thing.
Wow.
We were able to get it sold and lose just 10 grand.
Yeah.
But had I listened to the expert, then I would have got somebody out there for a few $100 and I'd have been fine. And that's just one example where my first turnkeys I bought, I didn't get inspections, and that ended up haunting me. So this idea and this concept of who, not how, has really, really been important to me over, I mean, for the last couple of years, more so than ever. But if I'm not an expert in something, I need to find somebody that is the expert.
For sure.
Let them use their superpower and, enjoy what they do, the things that I hate to do, and then trust their judgment when they give advice.
Right.
Probably the biggest piece of advice that I would give to somebody. So,
Right. That's a good one. There's a couple other things that I pulled out from that, which is, number one, get inspections on your property. And in fact, I actually, in the single family home space, I hate inspectors because they scratch the surface. So even when looking at single family properties, I hire individual people to come out. Someone who's an AC contractor to look at the AC, a roof contractor to look at the roof, So really specializing, because an inspector is much more of a generalist than a specialist, right? So that was definitely one thing I gleaned from it. And then the second was understanding people's motivations, right? So taking all advice with a grain of salt as well, because and understanding some of the motivations behind it. The person who gave you the advice on that Atlanta deal probably was just like, hey, if it were me, this is what I'd do. Versus, kind of hindsight 2020, looking at, the realtors just trying to get a sale. So that can always, that can add to the story always a little bit as well. So, those great takeaways.
I've got a really good friend. He says, if you go to the barber shop, you're probably going to get your hair cut. Right. So like if you go to any professional, that professional, I guarantee you, is going to give you some advice. So
exactly.
Be careful.
And let me tell you, there's always someone to give you advice. Like there's so many people speaking, and sometimes you have to be able to like dilute the noise, right? And figure out, okay, what's the key pieces that I need to take out of here? Because there's always some truth to what people are saying. So
absolutely,
what are the key pieces that I need to take out here and leave the rest kind of on the sidelines, right? So that's good stuff. Well, Randy, I appreciate you just taking your time out and joining us on this podcast. How can people find out, just if they want to connect, find out what you're up to?
Yeah, I mean, the easiest way to find me is on LinkedIn. If you do want to check out Impact Equity, my website is impactequity.net. And I've got a great freebie on there. If you put your name and email address in the lower left-hand corner, I've got top 10 questions to ask every syndicator before you invest. So
love that.
Definitely reach out, and I would love to connect.
Cool. Well, thanks, Randy. And thanks again for joining us on Lessons to Blessings. Till next time, stay blessed.